Over the past week, markets plunged and rebounded following President Trump's pause on reciprocal tariffs. Amid ongoing uncertainty and volatility, how should investors approach the market? Our guests weigh in with their expert insights. U.S. stock futures falling this morning as President Trump's reciprocal tariffs take effect. The latest drop sending the S&P 500 within 1% of a bear market. But some strategists are saying the S&P 500's drop below 5,000 means it's time to buy. So what's next for the stock market? Joining us now with their take, we've got Michael Kantrowitz, who is the Piper Sandler Chief Investment Strategist. Michael, good to have you here with us this morning. So is the drop below 5,000 a buy signal?
Not necessarily. I guess I'm more catalyst driven than I guess historically analog driven. I think it depends on investors' time horizon. Of course, a lot of stocks are down a lot more than the popular averages. So for those investors that are longer term focused, perhaps you can start to nibble in on some names that you want to own for the long term. Our clients are institutional investors that have to be largely invested most of the time. And so, we ultimately think the catalyst needs to be a change in the tone of rhetoric, and that a lot of historical analogs may not be as useful today because of this really unprecedented situation.
And talk to me about the retaliation we're hearing from China, that 84% tariff on U.S. goods. At what point, in your view, could the market just get fatigued of the constant ratcheting up of these tariffs? Or do you think that there's still more pain to come as we get these headlines?
It's certainly been a lot of shock and awe in the last week and a half, really since Liberation Day. And I think, we've certainly seen expectations of Trump's policy agenda come more in line with what is the current reality, whereas I think most investors were not believing that Trump would do what he ended up doing or anything near what he ended up doing. So that potentially could lead to a little less of a negative reaction. But if things continue to escalate and the duration of this persists, then we start to see the data get worse, and that could lead to people focusing on a more ominous outlook for the economy.
Michael, you mentioned you're catalyst driven. To what extent is this earnings season a catalyst either to the upside or the downside, as we're starting to get some of the kind of early thematic common denominators that could be cited among some of the most major and household name companies, and that word is uncertainty?
Yeah, well, I think it's interesting. Today we heard from both Delta Airlines and Walmart, two companies that really provided a huge negative shock earlier this year when they reported their earnings. And today, Delta Airlines, I think that stock is flat or even up a little bit, despite the market being down. They pulled their guidance, which I think we're going to see a lot of in this earnings season, because the reality is just that everything is so policy path dependent, and companies aren't going to really be able to provide high quality, high conviction guidance. Walmart maintained their guidance for the full year and for next year. So I'm not so sure we're going to learn a whole lot, but certainly expectations have come down a great deal with the market. And so I'm not so sure. I don't think earnings season will actually be a big negative catalyst. I think it'll give investors some hard data to wrap their hands around, some understanding perhaps of how business has been in the last couple of weeks. I think that'll be a question that investors are asking, because what happened in the first quarter at this point is really old news. But I think we'll see more corporate uncertainty rather than corporate bearishness. So it could be something that actually is more of a stabilizing factor rather than a big negative.
To what extent are valuations coming in a bit? And I'm hearing this question from a couple of retail investors, that they're nibbling where the valuation problem has gotten less significant. Is that something that you're hearing from substantial market participants, that valuations coming in might be a positive catalyst?
Yeah, certainly, we came into the year with extremely high valuations, and even if the consensus earnings numbers for the market, which really haven't come down all that much for the full year, are indeed what ended up happening. The market's multiple is still fairly high compared to history, and the issue with valuation is that if the earnings outlook is uncertain, and it is literally getting uncertain by the day, more uncertain by the day, then you don't really you can't really trust that valuation because you don't know if the earnings are to come in. You may be looking at a stock you think is trading at a 15 multiple because you're assuming the earnings expectations are solid, and you end up realizing, down the road that the earnings missed by 20, 30%, and the stock was actually, trading at 20 times back then. So and that's the issue for the overall market. So
Yeah.
I don't know if I don't think valuation is going to be a stabilizing factor for the market because of that uncertainty around earnings.
So then what are market participants hoping for? What is the big, great hope that you're hearing from folks? Because I can't find anyone, none of my sources have said that they are positively viewing these tariffs at this point. They just want them to go away. So what is the hope from participants that you're speaking with?
Yeah, so I've been trying to focus on, what could go right, because I think, like you said, the negative outlook and the bearish story is really easy to make, particularly if these tariffs all stick. And so it's unlike, again, any period in history in that usually markets go down because there's an oil shock or an interest rate shock or an inflation shock or an employment shock, a recession. And so you have data to look at. You can kind of we know how the business cycle works more or less. We know how the Fed will react in this period, in this backdrop. It's really the policy that's driving everything thus far. And not so much the economic data. We really haven't seen much bad economic data, at least with respect to hard data, because all this has happened so quickly. So it makes it, people want to see better, some kind of wavering, I guess, or some deals being structured. But, I think the expectations that the market's just going to bottom and shoot back up and that Trump's going to, wipe out all these tariffs is very unlikely. And I think we're going to be dealing with quite a bit a higher level of uncertainty for some time. Maybe we get some news on some deals or some negotiations start with China, but maybe they break down in a month, and so or maybe President Trump gets wants to go, gets upset by China and says, okay, the tariffs are back on, and so this is all possible. And I think that's going to maintain a high level of uncertainty in markets that are going to be quite choppy and very driven by the news. The other potential near-term catalyst could be that the courts put a stay on some of these tariffs. That was, or there's some delay in them. But again, that's a short-term Band-Aid, not a long-term bull case necessarily.
All right, Michael, we got to leave it there. Thank you so much for joining us. Appreciate it.
Where should you be investing during these uncertain and volatile times? One strategist shares his advice next. Where should investors focus during this time of uncertainty? Brent Schutte, CIO of Northwestern Mutual Wealth Management, offers his perspective. What a time to be alive, Brent. Can you help us just break down the thesis around yesterday's rebound from a self-induced near bear market scratch, and now ultimately what the trade looks like from here for investors?
Unfortunately, I think more volatility, as you mentioned in your opening. Look, we didn't dramatically alter the overall average tariff rate. We just shifted it towards China. And so if you think about that and think about the reality that tariffs are still out there, they're still on at the 10% level, they're on at the Chinese level, and they're on sectors, we still have tariffs higher than we have in the last 100 years, even after this quote unquote pause. And so to me, that means that there's more uncertainty as we negotiate and figure out what actually happens towards the end of the next 90 days. The second thing I would suggest is that I don't think the president's overall disdain for trade in general has changed. I just think he decided yesterday that he disliked the market's route just a bit less, as well as the bond market, which I think really caught his attention, and that's why he pulled back. And so overall, we're kind of still where we were. Certainly some of the tension has come off the boil, but there's still a lot of uncertainty out there. And to me, uncertainty means that people are more indecisive, CEOs and consumers alike, and that is the risk going forward in the next 90 days.
And there's also a risk that the big bounce yesterday was driven in part by short covering. There wasn't a lot of conviction behind it, and we're certainly seeing that play out this morning with stocks down again. If there wasn't that conviction in the market, then how do you suss out where we're heading from here?
Look, I mean, some of the biggest down days occur in bear markets, obviously, and some of the biggest up days occur in bear markets. And so to me, bottoming is more of a process, not usually a singular event. Yes, the VIX has spiked to high levels, but that is not always the coast all clear sign. Indeed, if I look at Friday's level on the VIX, which many people were touting at 45.3, if I go back and I think about a year forward, that typically does lead to higher returns. But just to give an example, the VIX hit 45.3 in September of '08. We still had 38.8% downside before you got to the other side where the rewards were a year out in the future. I'm not suggesting there's 38% downside left in the markets, but there certainly is probably more back and forth. And that's where I think any investor listening needs to understand that there is still volatility ahead. That VIX is probably a good entry point for longer term investors, but certainly not the coast all clear with ups and downs and back and forth in the market. And I still would advise people to continue to diversify because the place they continue to want to buy, the S&P 500, remains expensive. But there are cheap parts of the market, and that's where I think investors should focus on who are more long-term oriented.
What are those parts of the market?
I sound like a broken record, but if you're thinking long-term, you focus on valuation. That's part of the problem about why the market's not bottoming. Even if you take a discounted PE on the S&P 500, it still looks relatively expensive. The good news is small and mid-cap stocks, yes, they are more economically sensitive, but they trade at 13 and 14 times forward earnings. If you think about international stocks, I do think you are going to see a weaker dollar in the future, much like today. That is a tailwind to international returns for U.S. investors. They trade at 13 times earnings. And so I think there's a different world in front of us, much different than what we've seen the past 5 years where U.S. stocks have dominated. And that's where I suggest that investors continue to diversify and not just buy what has won over the past couple of years.
Well, one thing that has won in the last couple of years, of course, is the Mag 7. If you had to be a buyer or a seller right now, which one would you rather be?
I'd be a diversifier. And so maybe that's the way of not answering the question. Look, I know people have concentrated there. I know that's where the beloved Mag 7 and those stocks are. But if you look historically, the same 7 names don't always dominate every single year. In fact, the top 10 names in the S&P 500 over longer periods of time, just buying those and then holding the next year has been a losing proposition. And so to me, I think the market has to broaden out no matter what happens in the next few months, next few quarters. And I think if we're sitting here 3 or 4 or 5 years from now, the Mag 7 will no longer be the Mag 7. There will be new leadership atop that. And the market cap weighted S&P will also have new leaders at the top. And so that's where I would advise people. It doesn't mean you can't own some of these. Just don't make them your sole holdings, which I'm afraid so many individual investors are doing.
Given that, can you talk to me about your thesis on the equal weight S&P? Because that, if you were in the equal weight S&P yesterday, you kind of have a bad day. So how do you make the investment thesis for that moving forward?
Look, the last 2 years, less than 30% of the names in the S&P 500 have beat the index. That is historically narrow. That happens at the end of economic cycles when the economy narrows. What has happened, at least in the last 50 years on the opposite side of that, is a broadening. This period reminds me of the late 1990s, where you had similar characteristics. You had the U.S. exceptionalism commentary. People only wanted to own tech stocks. They wanted to own the top 10 names in the S&P 500. And what happened over the next 7 years was that the S&P equal weight dramatically outperformed. That's where valuations are cheaper. They trade at 16 times forward earnings versus 20 for the market cap weighted. And that's where I think investors need to think about the future and think about the fact that valuation is not a near-term timing tool, but it does win longer-term discussions. And that's where I would focus on that over top of the market cap weighted. It doesn't mean that you shouldn't own some of that. Just don't make it your sole holding, because I do think you're going to see a broadening of the market on the other side of this whenever that occurs. And I think different names will lead us going forward, just like they have in the past.
Brent, you raise a point that actually gets me to my next question, which is a lot of the volatility and the price swings that we've seen recently get people into the mindset of trying to perfectly time the market and not miss out on some of the massive jumps or to the downside, legs lower. So with that in mind, what are the average time spans, the portfolio spans that you're seeing from clients that you're speaking with, and how they're positioning themselves even amid some of the turmoil?
You want to know the really great news? If you have a financial plan, it takes into account the fact that markets go up and down and that the economy has contractions and expansions. And your asset allocation takes that into account. You don't have to make big decisions on any one day. If you're one, not concentrated, there's not one huge decision because you own a lot of different things. And number two, if you have a long-term asset allocation and you stick to that long-term asset allocation, it means you're likely to get to your goals and objectives. And so to take some of the pressure off of, do you add now, do you not add now? I advise people to go back to that plan, to go back to their asset allocation, and think about that longer term time horizon. Look, if you're buying stocks today, they're probably going to be good investments longer term. But I just think people have gotten so used to instant gratification where they buy every single dip because the Fed's going to rush in, because investors were underinvested towards stocks. That's not the case today. Americans have their highest allocation to equities they've had on record. The Fed is not going to rush in. It doesn't mean that stocks won't be a good long-term investment. It just means that there might be a little bit more time between you buying today and that instant and that gratification that you're going to have somewhere in the future.
Brent, all right, I'm going to fire up my T-shirt maker and get "I'm a diversifier" printed on that.
There you go. It's popular again.
It's popular again. Thanks so much. Good to see you,
Bringing
Brent.
it back.
Up next, Michael Darda, chief economist and macro strategist at Roth Capital Partners, joins us to break down the market's recent whipsaw and offer his advice on managing risk during a downturn. Michael Darda, chief economist and macro strategist at Roth Capital Partners, shares his insights on the economic impact of the U.S.-China trade war and what investors can do to navigate risk.
We're seeing another sharp sell-off today after markets bounced back yesterday. The seesaw, of course, reflecting and creating a lot of uncertainty. Investors trying to navigate risk management here. For more, we're bringing in Michael Darda, chief economist and macro strategist at Roth Capital Partners. Always great to see you. So it feels like with this whipsawing back and forth, obviously the coast is not clear. Does the name of the game here does it become minimizing the damage, managing one's risk? Is that what investors should be prioritizing here?
Absolutely. So whipsaw is definitely the right word for this. Financial markets are being whipsawed, and that's due to public policy being chaotic and also being whipsawed from one day to the next. So I think for investors, it's a matter of staying calm, staying diversified, looking at opportunities with these dislocations. But keep in mind, I think this is a process that's going to unfold over time. No one's going to pick the bottom. There's a lack of visibility now in terms of forecasting earnings. We talked about that the last time I was on, and your previous discussion about recession risk. I mean, obviously those risks have ramped up. And the market is telling you the same thing.
What is your outlook, Mike, for the economy in 2025, and how would you, sort of rank your recession odds?
Yeah, I think it's a 50-50 shot at this point in terms of recession hitting this year. That's quite high. In a typical environment, it's probably 10-15%. So that is elevated. And it's a shame because it looked like the Federal Reserve essentially had this soft landing in the bag in this huge tariff disruption, which is not over, has really thrown a monkey wrench into the soft landing. It puts the Fed in a terrible position where now they have to worry about downside risks to growth. At the same time, there are short-term upside risks to inflation. So if the Fed is sort of paralyzed here and the economy's weakening, that really does increase the risks of a downturn. And you can see that in various credit market indicators. High yield debt spreads have widened very sharply from quite narrow levels on a historical basis, but that's one of several things that you tend to see coming into a weaker growth period with higher risks of a downturn.
Mike, I was intrigued by a note you put out a couple of days ago where you talked about places that you were starting to see opportunity. Now, in this fast-changing market, I don't know if all of these still hold, but I want to ask you about them anyway. One of them was JETS, which is an ETF that tracks the airlines. We heard from Delta yesterday, which sort of pulled its forecast, part of its forecast, kept part of its forecast. So the markets were reassured by that, even before the overall market increase. But do you still think airlines are a good place to nibble at here?
Well, I think it really depends on the risk tolerance of the investor. But we were talking about areas that have just been crushed coming into the session before yesterday. Airlines, tech, energy, these are all down sharply again today. So I think it's important to keep in mind if you're leaning into these dislocations. The dislocation is there because of bad news, but the market's discount in real time. So if you're leaning against the wind a bit, I think that makes some sense. This huge reversal that we saw yesterday, then I think you want to step back a little bit. And now, we've given a big chunk of it back. So as I mentioned before, I think this is a process now in terms of this correction, potential bear market. No one's going to be able to time it. Typically with a recession, S&P 500 falls just over 30%. We were down at the lows earlier this week about 19%. So I kind of think of that as, you're 60% to 2/3 of the way through a recessionary adjustment. And so I think it makes sense to put a toe in the water and absorb a bit more risk for longer term investors that do have the tolerance to be in the market and to ride out the storm. But that is in no means an effort to say, this is the bottom or we've bottomed. I think those highs that we saw earlier in the year, probably aren't going to be back in focus for some time.
Mike, earlier in the show, I asked another strategist this, but I want to get your take too, because you are both a strategist and an economist. I am curious to get your take on what we are seeing with the dollar, Mike, and the continued weakness there, what you make of it, and what you think the ripple effects, the implications we need to think about from that.
Yeah, great question there. I mean, it's actually quite confusing because you have the dollar tanking. So normally people would think of that as inflationary. You have bond yields at the long end of the yield curve surging. People would normally also think of that as inflationary. But bond market inflation expectations have also cratered. So this move up in yields has been driven by real rates, and the dollar move, which has also come as a surprise, is not filtering into bond market inflation expectations. So I'm actually a bit more worried about recession than inflation. Yes, the tariffs are going to raise inflation in a temporary way, but that will not be sustained over time if the economy hits the skids. And I think that's what the inflation break-even market is telling you. We also could have a situation here, I phrased it this way for a client: if you're not going to buy our goods, we're not going to be able to buy your bonds. And so you could have a bit of a reversal in some of these capital flows going on as a consequence of the trade war. And we need to be careful what we wish for, because the last time the US ran a current account surplus was during the 1990-91 recession. So if you torpedo the economy and tank investment relative to savings, then the current account deficit can fall. But is that really what you're trying to accomplish?
Mike, always great to see you, my friend. Always great to have you on the show. Thank you for joining us.
Thank you for watching. You can stick with us on Yahoo Finance for the latest updates and expert insights on navigating your financial future.